Hello, I'm Jen Kohls, Associate Wealth Advisor here at Richardson Financial Group, and I'm joined with Dan Brown, our Director of Investment Management. We're here to provide an economic and investment update for the month of August 2022. So Dan, looking back this summer, we see that the markets experienced about a 17% bounce from the mid-June low through the middle of August. What factors contributed to that 2-month rally?
Sure, Jen. So despite the negative headlines, there's quite a few positives out there in the economy. One, the labor market is still fairly healthy. So we saw that with the last jobs report, about 520,000 new jobs being added to the payrolls. The unemployment rate ticked down again to about 3.5%, which is a post-COVID low. And then also we see quite a few job openings in the economy, about 11 million to be exact. And then on the earnings front, second quarter earnings season just concluded, and we saw that both earnings and revenues grew at an above average expectations, so fairly strong on the earnings front. Corporations continue to do well with inflation. And then lastly on inflation, we saw some inflation reports towards earlier in the month where we saw inflation we think has finally peaked and we think it's about to roll over. And that was, again, another reason why the equity markets did so well up until the middle of August.
Well, it was a nice rally while it lasted. However, the markets became more volatile the second half of August. Around that same time, the Fed met for their annual symposium. Dan, how were those two things related?
Sure, Jen. So the markets became more volatile towards the end of August as we heard comments from the Fed's annual Jackson Hole Symposium, where Chairman Powell talked very directly to the markets about that. At this point in time, goal number one is still fighting inflation, and they're going to use their tools very forcefully to do that, mainly through increasing interest rates. And Chairman Powell even said there'll be some pain that will be experienced in households and corporations due to the fact that they intend to fight inflation by raising interest rates. So it appears as that their mandate at this time is to fight inflation more than it is to support growth.
On the topic of inflation, we know the Fed's preferred inflation measure is personal consumption expenditures, also known as PCE. Dan, what can you tell us about our current state of PCE?
Sure, Jen. So the Fed has made it very clear this is their inflation measure that they're watching. And if we look at this current day, it's at about 4.6%. And the Fed has told us all along that they would like this measure to get back down to about 2% before they let up in their interest rate hiking cycle to control inflation. So we've got a little bit of ways to go. It's trending in the right direction for sure as it rolled over a couple months ago. But again, we still got a ways to go to get back down to that 2% preferred inflation measure. So what it means for future rate increases is we've got a Fed meeting in September, and we could probably expect another decent size hike at that point in time. It probably doesn't need to be the 0.75% increase that we've seen the past two meetings. So it could be a 0.5%, but again, we still expect a meaningful hike in September, and then probably a few more to finish up the year. And then as we look out much further into the hiking cycle, we would expect the Fed to be done probably early next year. So definitely have a few more months of interest rate increases to endure. But again, the economy is in a decent spot, but there is the real possibility that they could tighten too much and tip the economy into a recession.
So to review August, we saw the end of a brief market rally. The Fed held their annual symposium, and Fed Chair Jerome Powell shook things up a bit with strong commentary about the fight against inflation. Dan, how would you describe our future outlook?
Yeah, Jen, so we think the future rate increases from the Federal Reserve are going to continue to weaken economic growth and take a hit to corporate earnings. And we really haven't seen corporate earnings, at least expectations, come down really at all for the second half of this year and into 2023. But we think there is some pain to come there on corporate earnings. So we're actually going to take advantage of the recent strength here in the equity markets to trim the stock position a little bit here over the next week or two. And we will communicate that further, again, in about a week or so.
Well, thank you for sharing your insights, Dan. And thank you for watching. If you find value in watching our monthly videos, click like and subscribe below.